Hey everyone, it's Matt with the Fundamental Investing Institute. Back doing our videos after a months long hiatus, but it actually gave me an opportunity to think a lot about the format that we were using. So, coming back to doing these videos, what we want to do in the future is to focus more on principles, methods, philosophy of fundamental investing. So, what I was doing in the past is doing videos primarily where I was selecting two or three items from the news that week and talking about things that were potential macroeconomic risks. And these were things that I thought should be on the radar of investors, but they weren't necessarily things that had to be acted on, just things to be aware of. So, for example, talking a lot about rising debt to GDP ratios, not only in the United States, but other advanced economies, and how this might impact credit markets down the road, different things like that. And as important as those things are, the truth is most of the things that are in the news at any given week are really just noise. There's nothing to do with them. If you are an advocate of long-term fundamentals-based investing principles, as I am, the vast majority of the news items in any given week just don't have any real relevance if you're doing the kind of bottom-up investing that I'm an advocate of. So going forward, like I said, we're going to focus on really teaching basic investment principles. And the whole thing that we do at the Fundamental Investing Institute is we create content teaching investors and business operators how to use fundamental analysis to make investment decisions and to more effectively operate a business. So that's what we're going to do going forward. And one of the reasons for that is, the news cycle is much shorter than it has been in the past, and it's very easy to get kind of sucked into these exogenous events that may seem like they're important, for a given week or a given month or even a given day, but years down the road, they're not going to have much impact. So what I'm going to talk about today is what I think is a more intelligent way for investors to kind of use the news. It's really maybe a framework of thinking about how they can use the news in managing their investment portfolios. So I have a very simple litmus test that I try to use. I'm not always effective at it because I think we're all subject to cognitive biases, and we can all get sucked into this. But my basic litmus test is this. If I look at a news item, I'm asking, is any of this going to matter in 3 years? If the answer is no, and the answer is no to a lot of things, you can just kind of discard it. If the answer is yes, then you want to think about, well, how is that going to impact the companies that I own, the companies that are in my portfolio? So we want to start to integrate these things into the basic investment models that we're using and making investment decisions and an ongoing management of an investment portfolio. So, for example, when we were in a period of historically low rates, I thought it was very imprudent to just assume that we would be in a low rate environment forever. So whenever I looked at a company, I was always seeing how higher interest rates were going to impact their balance sheet, how it was going to impact their income statement, how it might impact the broader economy and the demand for their products or services. So these are the things we just want to kind of stress test our portfolio and integrating some of these macroeconomic events. The second thing we want to do is just to generally recognize that the world is an uncertain place. Just think about the last handful of years, the interest rate shock, different price shocks that we've had, the inflation shock, all those things are related, of course, that would have been unfathomable back in 2018, 2019. and just the general shock of COVID. And then going back shortly before that, we had the financial crisis. And so we just recognize that we live in a world in which these things happen. So when we buy companies, we want to use fundamental analysis to focus on businesses that are generating a significant amount of cash flow and have some kind of competitive advantage that will allow them to generate attractive cash flows in the future. That's key. Second thing is we want to focus on the financial strength of those companies. And this is another thing where fundamental analysis provides an appropriate lens for looking at it. How much debt is the company using relative to its assets? How much debt is it using relative to safer forms of equity financing? And then how well are the cash flows covering those debt service payments? So we have measures of financial strength. We want to focus on companies that have strong balance sheets. Remember going into COVID, where credit markets really shut down, it was very helpful to have companies that could access capital on attractive terms, or didn't have to access external markets at all. Apple's a prime example of this. It's a company that has a very strong balance sheet and has really needed no external capital in the last 20 years. It's been able to finance its operations and return a lot of cash to shareholders. So we want to focus on companies that don't have to have a constant reliance on financial markets, because we know that at times financial markets can break down. So if companies are constantly going into, say, short-term credit markets, and they're relying on that as a constant way of financing their business, that mechanism can break down, and has. So when we're thinking about all the possible risks and we're looking at the news, we want to make sure that our balance sheet, collective balance sheet, the stocks in our portfolio can withstand these exogenous shocks. So that goes back to the first question I was talking about, which is, does this matter in 3 years? We need to be able to survive the long term if we're going to focus on the long term. And that means using or buying shares in companies with strong balance sheets and strong cash generating abilities. The third thing that we really want to focus on as investors when we look at the news is we want to focus on different industry changes. For example, we look at how artificial intelligence is disrupting companies that even just 6 months ago or a year ago we would have thought had very strong competitive advantages. The software industry is very attractive, has very attractive, or did have very attractive economics for different reasons. And we look at some of the AI tools that are out now, they're allowing companies to build their own software programs internally and do so at a very low cost and customize things in ways that external software providers could not do, or at least not at that cost. It is disrupting the future economics of the software industry in a major way. And these are the things that we have to try to pay attention to. So as much as there is uncertainty under artificial intelligence, we want to think about what are the opportunities that is creating, what are the risks, what industries are the most vulnerable, and what industries are going to survive that disruption. There are a lot of industries I can think of where I don't think AI is going to completely eradicate it. Costco is a company that I'm confident saying 5 years from now is going to be a bigger and stronger company than it is today. There are a lot of other companies I can think of that are providing basic goods and services that will integrate artificial intelligence in different ways, but are not going to be replaced by them by any means. So we want to think about the pace of disruption within an industry. Now, technology is not the only driver of that. One of the things that's happened in the last handful of years, for example, is there have been changing consumer tastes that have harmed a lot of or impaired a lot of companies that we wouldn't have thought that would happen to. So, for example, alcohol consumption has really plummeted, especially among younger people, and that's impacted a lot of different companies. We've been more health focused, so companies like Coke and others who have had to shift their strategy to healthier options. There are a lot of things like that and companies that we would have thought had a very strong competitive advantage have in fact been impaired, had to change their strategy, etc. So that's another thing that we want to pay attention to when we're looking at the news. And the other thing is we want to pay attention to competitive threats. So if you're reading different news sources and you see that there are new entrants coming into a market, there are new competitors, or there are major investments that are being made, we want to think about how that's going to impact the industries that we have exposure to. So all of these things matter. What doesn't really matter if you're a long-term stock investor in any given week are things like gold and silver prices. I think they're fun to pay attention to. I think there's some basic economic information that's available to them, but it's not really going to impact your portfolio. Likewise, a lot of the political partisanship is not going to impact your portfolio that much over the long term. It can certainly make things look very hectic, but the point is a lot of the news, and I think more and more so than even in the past, a lot of the news is just noise. And so that's the challenge for fundamental investors, is to try to filter what we would call the noise from the signals, the things that we should actually be paying attention to because they impact the long-term value of our investments. But going forward, when we do these videos, we're going to really focus on teaching the application of fundamental analysis to investment selection and portfolio management for individual investors, and also how to apply fundamental analysis to the management of businesses. Until next time, have a great week.